right, I've been holding for 10 minutes, so we about to get this ball rolling. Um, I ain't been here in a while, so I know the algorithm ain't pushing shit out. That's all good. We got enough people here. If you're here, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Let's help to get this stream out to people because it's going to be very educational, right? I said men, women, and numbers, a lesson in working together. So a partner of mine introduced me to someone else who is in the financial services industry who was uh, in a bit of opposition to my strategies, some of the strategies that I talk about, for example, the infinite banking strategy or the private reserve strategy is what I call it. And he mentioned to get buy term insurance and invest in a brokerage account. And unfortunately, he fell to practices that a lot of people who are in that position, who unfortunately don't get into certain circles or certain degrees of wealth, get taught to do. One major thing they'll do is attack your character or attack the product, right? Because oftentimes they're not dealing with someone such as myself who is going to remain stuck because I've been through it. I understand it's battle tested, right? It's like when you deal with, a fighter, right? Mike Tyson is going to walk into the ring and he's going to be like, okay. And maybe this new guy who's never heard of or never encountered Mike Tyson going to be, rah, 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 I'm going to get you. Mike Tyson is looking at him like, bro, I done been through this before. I done knocked a whole bunch of folk out, right? You saw when Mike Tyson fought Jake Paul, he had to pause, right? So before I get into that, one of the things that I understand with the gentleman is that he was mentioning a lot of insurance agents who are trained a certain way. So I've been over on TikTok teaching in a certain manner, which is 5 questions that you need to ask your financial professional, any type, when you're sitting across from them before you sign on any dotted lines. 5 questions you need to, and I did start a little early because I was gonna start at 4:40, but my food came quicker and I ended up finishing it quicker than I thought. I thought it was gonna take a little over an hour. It took like less than that. So ladies and gentlemen, it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance bro, and registered financial consultant. And I've returned today to whap and tap on your head with yet another ADH Wealth Solution. Make sure to hit those likes, drop the comments, subscribe, and hit that notification bell so you're made aware every time I release new content. And again, as always, share, share, share. So with that being said, we're going to get into those first 5 questions. So, question number 1 is simple. How can you help me can you help me determine the amount of life insurance coverage that I need? Can you help me determine the amount of life insurance coverage that I need? And a lot of people are unable to do so because they don't know how to help you determine the amount of life insurance coverage you need. It's very simple to do. It's a very simple thing. There's a few ways. One they can do is by something called the dime method. Hold on. What up, niece? No, it doesn't matter as long as it's an email address. People have all sorts of weird email addresses. That's perfect. Yeah, just lazy. What you right now, and then boom, you're good. I mean, I know a bunch, but I don't know any off of the top of my head. I got one for you. Hold on. 11233. Yeah, I got you. I'll text it to you. I'm on a live, so I'll text it to you in a minute. That's a house. Brooklyn, New York, 11233. Yep. All right. Love you later. Give me 1 second. I got to sneeze now, y'all. That was my niece. So, again, first thing we're going to ask, and this is why I said men, women, and numbers, because, again, a partner of mine brought me into a phone call with an IAR, which is an investment advisor representative, who is hopefully going to go independent. What's up, Cynical One? How you doing? What's up, Just Ask Shar? How you doing? Thank you guys for coming. And the reason I'm doing this is because men lie, women lie, and sometimes numbers lie if you don't know what they're doing with the numbers. So I want to answer the 5 questions tell you the 5 questions that you need to ask any financial professional that you're sitting across from before you sign on any dotted line, and what the importance is behind that. Because it's very important that you understand what you're signing and why you're signing what you're signing when you're signing what you're signing. And why is that? Because what will end up happening is you will get into some nonsense if you don't know what you're getting into, right? And you may be misled by an investment advisor or an insurance agent. What I've noticed is there are a lot of insurance agents who don't know what the fees are they're talking about. And I've realized this because I've been spending a lot of time on TikTok, and I've been neglecting you guys here, my YouTube audience, who are the real deal people. Not saying that people aren't real deal in TikTok, but y'all are the real deal. Y'all actually spend time, and they call it YouTube University for a reason, right? People come here to learn, and I found people are more serious over here. Yes. Are people having dick and pussy conversations over here like they are on TikTok? Absolutely. But when you're not having those conversations, you tend to get into real conversations as well. Shout out to my man, like Sheep Stay Sleep, right? He talks about valuable information stuff that we can actually use in our actual, oh shit, what did I just drop? In our actual lives. And so question number 1, can you help me determine the amount of coverage that I need? Question number, and the way that they can do that is a couple of ways. An insurance agent will do something called DIME, D-I-M-E. I'm going to put that in the chat. DIME, right? And DIME stands for debt, income, mortgage, and expenses. Some people will say education, right? Meaning if you got kids and you're saving for education. I don't use that. I say expenses because debt does not include your expenses, right? Debt is I owe student loans. Expenses is I'm paying this fucking Netflix account. That's an expense, not a debt, right? You don't owe Netflix unless you're behind on your bill, but you don't owe Netflix any money. You pay Netflix because that's an expense that you take on. Mortgage and rent is an expense, but we actually want to account for that separately from everything else, right? So again, I'm going to put DIME, debt, income, mortgage, INCOME, income, mortgage, expenses. That's DIME. So that's one simple way that they can help you determine the amount of life insurance coverage you need. There are further in-depth ways that you can do that. We'll get to that probably in the near future. Question number 2, what products can you offer me? So this is going to actually matter because it's going to base what the products that agent or representative can sell to you. So for example, I am not securities licensed. So technically I cannot sell you a securities product, but I have securities licensed representatives at my firm. And a lot of these other people act as if when you're an insurance only agent, you don't have securities licensed representatives. For example, the gentleman who was on with me was like, I started at Mass Mutual. I told him that's my broker dealer because yes, there are life insurance agents there, but they also offer securities, right? And then to say I was at New York Life. Well, if you're at New York Life, you don't get the Series 6 and the 63 because that's an enhanced insurance license. You get the Series 7 and 66, which is an actual fucking investment license. So I'm tired of dealing with people who don't know what the fuck they're talking about, getting all this attention from especially my folks, the black people, right? So, I get spirited and I gets the cussing. And so question 2, what products can you offer me? A lot of people who are with these IMO, these bullshit life insurance only organizations, only get their life license. So they can only sell you term life insurance, whole life insurance, universal life insurance, and indexed universal life insurance. They can also sell you fixed annuities and indexed annuities, right? Now, if they have their life and health license, they can sell you all of that, plus a hybrid long-term care life insurance policy, a disability standalone policy, a long-term care standalone policy, major medical, which you know is health insurance. They can also all sell you a 401k because you don't need to be securities licensed for that, or an IRA because you don't need to be securities licensed for that, but you do need to be securities licensed to give you specific advice on the allocation of the money. So it's a delicate dance. And the reason it's so delicate is because there are so many people who, this industry has a 92% fail rate. So if you go to get your license and you go to a licensing course and there are 10 people in that course, within 2 years, 9.2 of those people are going to be out. So that means 10 people come in and 10 people go out, right? Because 9.2 is closer to 10 than 9 because it's past 9. So again, we have a 92% fail rate in this industry. Now, when it gets into securities, it gets a little less. But why is that? Well, when people are selling investments, here's the thing about investments versus permanent life insurance. Term life insurance pays out 1% of the time. So it's a hell of a lot easier to qualify for because the insurance company knows they're likely never going to pay you. So they don't go through as rigid underwriting as they would with a permanent policy. So the agent who's like, buy term, invest the rest, they want to make sure they get their fucking commission. So if they sell you a term policy, they know that it's not going to be a whole bunch of underwriting. It's not going to be a whole bunch of rigmarole to make sure that you get that policy. Prime example, I'm writing a policy on a man in Florida right now. He said no to use of tobacco, right? They came back to me and said, well, our records indicate that 5 years ago you had tobacco in your system. 5 fucking years ago. It's 2026, bro. That was 2021. He had some tobacco in his system. But he's applying for a permanent policy. So they're going to go through that policy with a fine-tooth comb, right? To make sure of everything. So now they tell me, well, we want to know how long he was using tobacco, how much, what type, when he stopped. So now I got to go find out all this extra information. He's like, bro, I stopped tobacco. I used to have cigars once a month, a couple years ago. Well, they saw it. They want to know every detail about it. Do you think he knows every detail? Now, if I would have sold him a term policy, you know what? Oh, okay, issue. Because they know they got a 99% chance he ain't never going to die in the next 10, 20, or 30 years at his age. They've already calculated that. So it's easier to qualify and earn my commission on the term policy. You ain't going to ask no questions as a customer. Because it's very basic. It's like a bike versus a car, right? A bike is very basic. You got 2 pedals, you got 2 wheels. You see the chain that's connected to the back wheel. That's how it works. But a car engine is a lot more complex. That's why you need a mechanic. Shit, a lot of people need somebody to help fix their bike. So question number 3. A lot of insurance agents don't like this one. How are you paid? Right? So there's 3 different ways that an insurance agent is paid. There's commission only, which is the most common insurance thing. So let me explain to you why that's important versus, again, that registered investment advisor. Because they know the term insurance is cheap, but the insurance agent complex, what's going on? He said, I can fix their bike. They know that term insurance policy, you're going to issue, you're not going to ask any questions, you're probably going to keep it, right? But they also know that they have to earn that commission. So you got to keep that term insurance policy for 13 months. But they know with a brokerage account or an investment, they don't have to do much of anything. Once you pay that money, that's that. If you lose money, oh, well, maybe they'll lose their 1% wrap fee, but they won't lose their entire commission. So with investments, you just pay them the money, right? So the second way is fee only, meaning they charge you a nominal fee up front and then they don't get any commission based on whatever product you purchase from them. Whereas commission only gets paid a commission based on the product you purchase from them. And then the third way is hybrid or fee-based, which is what I am. I charge a nominal fee up front, and I get a commission from the company should you place business with me. Let me tell you why you're going to like that model the most. You'd be like, I don't know, you're getting paid twice off of one work. Why do I want you to do that? I think I'd rather go with the fee only or the commission only guy. Well, the commission only guy has commission breath. Listen, if you don't buy something and he sits with you for 2 hours, he wasted his fucking time. So he's going to make sure that you buy something from his ass. The fee only person, well, they don't have any interest in giving a fuck about what's called renewal commission or persistency. Once you give them their upfront fee, they don't have to care about if you're in a product that you can afford. They can put you in something that you can't afford, something that's too much, something that's too little. They don't have to take care of you. But a fee-based person such as myself, I earn your fee. And yes, if you don't place business, okay. But now I'm not giving you pressure to buy something. Buy this, buy this, buy this, because I've gotten my fee up front. Now, why I get the commission? Because there's trail commissions. Every year you keep that policy, I get 1% of what you paid into the policy for the year. So if you pay $1,000 a year for a policy, I get $10. I want to keep my perpetual $10. It's not a shit ton of money. But if I got 1,000 people paying $1,000 a year on their term life insurance, let's say, and I get $10 a year off of 1,000 people, that's $1,000 or $10,000 that I've earned for something that I did 3, 5, 7 years ago. So I have a vested interest to make sure that it's something you can keep. And I don't have commission breath, meaning I'm not going to force you into something that may not be good for you. So that's why you want a fee-based, meaning they charge a fee and get a commission. Question number 4, are you captive or independent? A lot of agents are captive, meaning they work solely for one company. You see, I'm independent. I'm truly independent. Unlike a lot of these people who are with these bullshit IMOs, GFI, PHP, Experian Financial Group, World Financial Group, Transamerica, which is World Financial Group, PHP, FFL, Primerica. Those are all, well, Primerica is exclusively captive, but all those are captive, even though they're like, I'm a broker. If somebody sells life insurance and tells you're a broker, they don't know what the fuck they're talking about. Or more likely than not, they know you don't understand the terminology and you understand what a broker is, meaning that they can represent a lot of different carriers. Give me 1 second. I got another phone call. Hold on here. was another business partner of mine who I was doing some work with. So I needed to take that call very briefly and make sure that that happened. Because, it's another young brother that I'm working with, and I want to make sure that, that's why I said a lesson in working together, because the brother that I encountered that my man's talked to me about, listen, I was like, yo, I don't have no animosity toward the brother. I want to work with him, right? It's another black man, and there's not enough black folks in this industry. The CAAFP, Conference of African American Financial Professionals, said that I believe it's like 7% of licensed financial professionals are black. So if we can come together like Voltron, we can actually do things like close the racial wealth gap in our community. So question number 4, are you captive or independent? There are a lot of captive agents with, that GFI, that PHP, etc., or independent, meaning they're truly independent. They may tell you that they're a broker just because that's easier for you to understand. Lastly, you want to ask, once they make a recommendation, hey, Shar, I think you should buy term and invest the rest. Hey, Shar, I think you should buy a whole life. Hey, Complex, I think you should buy an IUL. Can you show me the financial strength of this company, Alonzo? So the way that you ask that question is, yeah, can you send me the annual report of the company you're recommending? So the annual report is very similar to if they're recommending an investment, you want to say, can you show me the prospectus? I'm going to type that in the chat. Right? Because maybe more people will come in here when I start talking investment shit, but I'm talking investment shit on the level where motherfuckers really do this shit. Remember, my black ass was on Wall Street, 100 Broadway. You come downstairs, take 2 lefts, the New York Stock Exchange was right there. I was a stockbroker trainee at a company called EJ Sterling at 39 Broadway. I used to be able to come outside, walk across the street from 11 Broadway, and grab the brass bull by the balls like the Asians did, because it was a sign of virility and that you would make money. No pause, because I'm confident in mine, right? Plus, them Asians ain't talking about pause. And guess what? When I went to the Yale commencement, Yale graduation, which Yale is the Ivy League school with the highest concentration of 1% children, I seen a shit ton of Chinese people there. Meaning they ain't playing these bullshit senior citizen fucking Jim Jones bullshit game. Pause. You said banana. You said sausage. No wonder nobody take black men serious. We fucking 50 years old talking about pause. Pause. Anyway. So those are the things that you want to ask for. Now, let's get into the meat and potatoes of today's argument, right? So the gentleman was talking about buying term and investing the rest in a brokerage account with an S block. So I just happened to go to AI, and we're going to go to the very top of AI, very top of this, because it gave me some interactive things and stuff as well, right? It gave me charts and everything. So I said to it, let me bring myself down here. As you can see, this is my AI, right? Boom. So I said, if an agent is recommending a brokerage account, how do they get paid? Percentage? Do they have a wrap fee and a 12B1 fees? Please explain. They are saying a brokerage account and an S block is better for the client than using the infinite banking strategy with life insurance. Now, what's crazy is me and my boy witnessed a lot of the stuff that you're going to see here in live time. The other gentleman was doing a lot of this stuff that AI is going to say he was going to do. And again, the reason I went to AI is because there's no bias. AI doesn't give a fuck what it is, because AI don't get paid, period. The only way they get paid is from me paying for their subscription, right? So I said, when a securities licensed agent recommends a brokerage account paired with an S block, securities backed line of credit. And the reason this is important is because I have too many motherfuckers. Well, I'd rather buy term and invest the rest. First of all, motherfucker, you ain't got enough money to invest, to be quite frank. I hear motherfuckers on here all the time. I'm day trading with a cash account. Bullshit. Matter of fact, before I go here, we're going to go to FINRA and look at the FINRA day trading rules. FINRA day trading rules. right? So let's go to FINRA.org, the Financial Industry Regulatory Authority, right? Do you actively trade stocks? If so, it's important to know what it means to be a pattern day trader because there are requirements associated with engaging in pattern day trading. Once you understand the requirements you must meet, you reduce the risk that your firm will place restrictions on your ability to trade. Day trading, as defined by FINRA's margin rule, refers to a trading strategy where an individual buys or sells and buys the same security in a margin account on the same day in an attempt to profit from the small movements in the price of the security. FINRA's margin rule for day trading applies to day trading in any security, including options. Day trading in a cash account, because these niggas always tell you, you could get the cash account. Hold on. Let me increase the screen so y'all can read along with me. Right? I don't go to the bullshit when I teach y'all shit. Other motherfuckers go to the bullshit because they know they're bullshitting, so they resort to bullshit. I tell you the fucking truth. Day trading in a cash account is not permitted. Again, this is from FINRA.org. This ain't from Alonzo Hall's mouth. This ain't from the nigga trying to sell you some shit's mouth. This is from FINRA itself. I was actually on live with a nigga who said, I had a FINRA number. Nigga, you don't know what the fuck you're talking about. There's no such, FINRA doesn't know what a FINRA number is. They know what a CRD number is. But again, we keep having fucking Wall Street Trapper and fucking Jay Morrison coming to us. But when people who actually have the knowledge and the credentials come in, I get 2 people watching my shit. 100 people watching dick and pussy content, 100 people watching Jay Morrison lie to you. Now when he lied to you, everybody wanted to tell, oh, he's a fucking scammer. I knew he was a scammer. No, the fuck you didn't. You was eating that shit up. All securities purchased in the cash account must be paid for in full before they are sold. In the cash account, under FINRA rules, purchasing a security, paying for it in full as required by Regulation T, and then selling the same security is not considered a day trade. So these niggas, I'm day trading. No, the fuck you're not, nigga. FINRA says so. But they know that you don't know where to go get this information because they don't know where to go get this information. They just have a shit ton of confidence. What's that, Kev, the black dude with the BBL? He's talking to Brother Ben X. He's talking about insurance now. So now it is even more dangerous in my industry, just on the insurance side. But motherfuckers been telling you about this. There's people here on this app could join my course. Well, guess what? When you join their course, everybody paying them hundreds of dollars. He charges $1,000. 25 people do it. Now he's got enough for a fucking margin account. You don't. Who is a pattern day trader? According to FINRA rules, you're considered a pattern day trader if you execute 4 or more day trades within a 5 business day period, provided that the number of day trades represents more than 6% of your total trades in the margin account for that same 5 business day period. Nigga, I get up every day and trade at 9 a.m. and I'm done by 11. Yeah, them niggas get up every day. They get on TikTok. They get on Instagram. They get on Facebook. They get on YouTube. They fucking tell you a bunch of lies. Basically, what them niggas is telling you is this. Because a bunch of men fall into this. A bunch of these men up here who are mad about Keisha. I'm fucking bad bitches because I'm watching Pornhub. Well, you're not fucking bad bitches. You're fucking your left hand and Jergens, looking at the bad bitches. But you're not actually engaging in the intercourse with them. Yeah, I'm going to get rugged and raw. Because this shit ain't no game. They fucking up your money. Right? There are 2 methods of counting day trades. Please contact your brokerage firm for more details on how they count trades to determine if you're a pattern day trader. The rules also require your firm to designate you as a pattern day trader if it knows or has a reasonable basis to believe that you'll engage in pattern day trading. For example, if the firm provided a day trading training to you before opening your account, it could designate you as a pattern day trader. In general, once your account has been coded as a pattern day trader account, a firm will continue to regard you as a pattern day trader, even if you don't day trade for a 5-day period, because the firm will have a reasonable belief that you're a pattern day trader based on your prior trading activities. If you change your trading strategy to cease your day trading activities, you can contact your firm to discuss the appropriate coding of your account. What are the requirements for a pattern day trader? First, pattern day traders must maintain minimum equity of $25,000 in their margin account on any day that the customer day trades. Am I making that up, or is this from FINRA.org? Hold on. I'm going to put this shit in the chat because maybe you don't believe me. Maybe you want to click on it yourself. Bam. FINRA.org/investors/investing/investment products/day stocks/day trading. So I'm growing tired of motherfuckers with the motherfucking bullshit. I am being very calm with a lot of them, right? I don't want to bring the asshole out on a lot of them, especially if it's another black man. It's okay, bro. You don't know what you don't know until you know don't know it. Just like you encountered with being in the insurance industry. You ain't know what you ain't know till you knew you ain't know it. Then you got buffered into getting a Series 6 and 63 thinking you're doing something. I got the Series 6, 63, SIE 65-7 exam manuals. I just didn't take the exam because then if I took the exam, I couldn't come here and tell you, the general public, the fucking truth. His homeboy tried to jump down my throat. You're a car salesman. I was in the mortgage industry. You must not have been very successful in the mortgage industry. The NMLS, National Mortgage Lending System, fucking exam manual tells you that cash value life insurance can be looked at as an asset. See, when you're dealing with a Rudy Poo butt ass nigga, they're going to fall victim to that. But when you're dealing with a real pro versus a content creator, that shit don't move me. The only reason I'm doing this is because it sounded like content. And I haven't made any content in a while. So this required minimum equity, which can be a combination of cash and eligible securities, must be in your account prior to engaging in any day trading activities. If the account falls below the $25,000 requirement, the pattern day trader won't be permitted to day trade until the account is restored to that $25,000 minimum equity. So now let's just go back to what I was talking about here. We're going to go back to my Gemini. Right? We're going to go to the very top of my Gemini. So we're going to look at how the securities agent gets paid. Right? You guys can see this here. Right? So let's look at this here. If an agent is recommending a brokerage account, how do they get paid? Percentage. Do they have a wrap fee and a 12B1 fee? See, you, the general public, don't even know what the fuck any of that is. AI is going to explain it to you. Please explain. They are saying a brokerage account and an S block is better for the client than using the infinite banking strategy with life insurance. AI responded. Now remember, AI doesn't have a dog in the fight. AI doesn't care. It says when a securities licensed agent recommends a brokerage account paired with a securities-backed line of credit over an insurance-based private reserve strategy, it usually comes down to two things: protecting their compensation structure and a fundamental misunderstanding of guaranteed collateral. Here is the breakdown of how they get paid and exactly why their S-block argument falls apart under pressure. I put slight pressure on this brother today, and hopefully he's watching. I welcome him too. Because like I said, I'd love to work with him. He had some passion, but you got to get over that Rudy Poo bullshit that they taught you at the academy, bro. You came for training day, nigga. My name is Alonzo, like Alonzo in fucking training day, cuz. This shit real. How the securities agent gets paid. Securities agents and advisors typically operate on an AUM model. They only make money if the client's capital stays inside their brokerage ecosystem. The wrap fee, AUM fee. A wrap fee is a comprehensive annual charge that bundles investment advice, portfolio management, and trading costs into one flat percentage. This usually ranges from 1 to 1.5% of the total value annually. the forever revenue stream. If the client moves $500,000 into a life insurance policy, the advisor loses that AUM and the recurring fee. If the client keeps it in the brokerage account and uses an S block, the advisor continues to charge their 1.5% wrap fee on the gross portfolio value year after year indefinitely. So if you have $500,000 and I'm charging 1%, that means I'm charging you $5,000. Now your account magically grows to $1 million. Oh, well, my account, my brokerage fee, my 1%, we're not even going to say 1.5%. My 1% is now $10,000. You go up to $2 million, $20,000 every fucking year for no fucking reason. Because often they put it in a passively managed account, like a brokerage account. Put it in VOO, VTI. And he says, well, what? I said, well, the insurance companies are QIBs, which is a qualified institutional buyer. Yeah, but if the insurance companies are doing this, why would you let them do it instead of doing it yourself? So I asked, well, then why would they use you instead of doing it themselves? Oh, well, because I brought it to them. Well, yeah, but the insurance company is a qualified institutional buyer. So they're buying in swaths. So while you're going down to the corner store, buying a small bottle of mayonnaise for overpriced, they're going to Costco and they're buying an entire crate of mayonnaise for substantially less than per fucking single jar of mayonnaise than you are. And they've been in business substantially longer. So let's put it to you like this. If he can invest $1 million a month, the insurance company can invest $1 million an hour. Remember, if you can invest $1 million a month as an accredited investor, the qualified and most people are retail investors, so they can invest $1 million every 10 years. The insurance company can invest $1 million an hour. That's $24 million a day. Multiply that by 1 month. Then come holler at your boy. Because the insurance company is then acting as your de facto bond desk manager. And this ain't shit in AI. This is me telling you this because I know what the fuck I'm talking about. So that's why I'm able to put it into AI and have it give you germane, actual answers. Because most people would put a guy's recommending a brokerage account versus life insurance. Right? Which is better? Well, you don't know about to ask, how do they get paid? Do they have a wrap fee? Do they have 12B1 fees? You probably don't even know what the fuck a 12B1 fee is. Please explain. They're saying a brokerage account in S-Block, securities-backed line of credit, is better than infinite banking. So 12B1 fees. The advisor places the client's money into a certain mutual fund. The fund companies charge a 12B1 fee, legally capped at 1%, typically 0.25 to 1%. So remember, that 12B1 fee is on top of his 1%. So he was arguing, well, listen, you know, Vanguard, it's very inexpensive. It's like 0.5%. It absolutely is. However, when you also charge your wrap fee, that increases the fee that the customer has to incur. So, while for marketing and distribution, while fiduciaries are increasingly required to use institutional shares without these fees, many broker-dealers still collect them as a hidden layer of back-end compensation on top of the wrap fee. The pitch. The agent will argue that an S-Block allows the client to keep 100% of their money in the stock market, aiming for 8 to 10% returns. I asked the brother about Dalbar. Let's, in fact, do that really quickly. Let me bring this down. Remove. We're going to go to another screen. And we're going to pull up Dalbar. Because, again, I don't tell y'all bullshit. I tell y'all real shit. Dalbar, right? Dalbar Inc. So he brought up some bullshit. Dalbar study on investor returns. Let's go Dalbar average investor. Right? The Dalbar QAIB, Quantitative Analysis of Investor Behavior report, consistently reveals that the average equity fund investor underperforms major benchmarks, often earning only roughly half of the stock market's returns. This underperformance is primarily caused by emotional market timing, where the investors panic or sell during downturns or buy too late during rallies, right? So again, Dalbar is an investment study group. So when I ask you, brother, are you familiar with Dalbar? Don't tell me. I can bring up independent studies that you're probably not familiar with. I'm sure you can, but that's like asking, hey, motherfucker, you heard of McDonald's? I can bring up a burger shop. I bet if I tell you all about Lewis Lunch, which is here in New Haven, Connecticut, which is the birthplace of the hamburger, nobody would fucking know about it. But if I said, hey, have you heard of Lewis Lunch? I can understand you saying that. But if I said, hey, have you heard of fucking McDonald's? Don't dance around the question, sir. Answer. So let's continue. I'm going to bring back the AI up. It's hot as shit in this house. The pitch, why they will say the S block is better. The agent will argue that an S block allows the client to keep 100% of their money in the stock market while borrowing against the low interest rate. That will point out that there are no life insurance premiums, no cost of insurance deductions, and that the S block doesn't trigger capital gains. Nigga, I'm not doing it. In a perfect perpetual bull market, this sounds highly efficient. In reality, it exposes the client to catastrophic risk. Let me check the chat here. Cook, thank you, brother. So the core difference between the two strategies comes down to collateral stability. You've got the feature of the S block with the brokerage account or the life insurance private reserve. So number one, you have market risk. It's high. It's tied to volatile equities. Life insurance, zero. The cash value never drops due to market loss. Margin calls. Yes, the bank will liquidate assets during a downturn to cover the loan. So if you got money out and now the stock market goes down, oh shit, well, guess what? You had a $500,000 account. You borrowed $250,000, leaving you with $350,000, and the market dropped 30%. Hey, motherfucker, we gonna go ahead and sell this $350,000 to cover that loan. Oh, by the way, I know you didn't see any of that money, but you got to pay capital gains taxes on that shit. Money you already spent. The insurance company, no, the insurance company will never issue a margin call due to market volatility. Interest rates tied to indexes like the SOFR. If rates spike, loan costs spike. Fixed or indexed, guaranteed loan rates, or wash loans lock in predictability. The fee drag, 1 to 1.5% wrap fee charged annually on the total balance. Insurance, front-loaded insurance costs, but highly efficient long-term with zero AUM drag. Self-completing, no. The estate must settle the S block debt against the portfolio. Life insurance, yes. The tax-free death benefit instantly wipes out the loan balance. So, ladies and gentlemen, what are we talking about here? It says you can use this interactive tool to visualize how wrap fees and market volatility impact both strategies over time. So we've got the S block net equity and the policy net equity. So S block, 10-year return at a market return of 7% with a 1% wrap fee, right? The S block rate we're saying is 6%, and the policy loan rate we're saying is at 5%. From year 0 to 10, we start at 60K. Let's look. The blue line is the S block. Blue line stops here, 31,559. Right? Hold on. And the loan to value is at 40%. If you're at 40%, you're over leveraged. We'll get to that shortly. Right? Where the policy is the green line. Oh shit. 131,559 versus 107,451. The margin call risk is very low on the insurance policy. The fatal flaw of the S block. Banks lend against securities as non-purpose credit. If the market drops 30%, the client's $500,000 portfolio becomes $350,000. If they have $250,000 S block outstanding, the bank issues a maintenance call. If the client doesn't have the cash to satisfy it, the bank liquidates the portfolio at the exact bottom of the market. So that means that it's worth the worst possible price. They're not going to sell it at the best price. They're going to sell it at the worst price, which is actually in the best interest of you, because that may mean that you pay less capital gains taxes, but not really, because if they got to liquidate the whole 350, they're going to liquidate the whole 350. Now you have to pay capital gains on 350. The client loses the asset, locks in the loss, and still owns capital gains taxes on whatever was forcibly sold. According to Regions Bank, with a properly structured cash value life insurance policy, the floor is zero, the collateral is contractually guaranteed, the securities agent is recommending an S block because it protects their AUM revenue streams, not because it protects the client from risks. So I said, please present a counter argument to this. I was trying to counter the argument and argue in favor of the S block, right? So it said, to effectively compete against the securities advisor, you have to know exactly how they are going to dismantle the life insurance argument. When they pitch a brokerage account in an S block to a client, they're going to attack the frictional cost, the cap's return, and the inflexibility of the insurance contracts. Here's the strongest counter argument the securities advisor will make for why the S block strategy wins: the frictional cost of day one capital. So they'll point out that life insurance is an incredibly expensive wrapper in the early years. If a client puts $100K into a brokerage account, $100K immediately goes to work compounding in the market. If they put $100K into a cash value life policy, even if it's heavily overfunded and designed to the absolute minimum, they still have to pay premium taxes, cost of insurance, and administrative loads. The advisor will explain that their year one cash value is only $80,000 to $85,000, and they'll argue the opportunity cost of that $15,000 to $20,000 of principal day one compounded over 30 years supposedly vastly outweighs the 1.5% wrap fee they charge on the S block. All right? Uncapped equities versus policy caps. They're going to say that, oh, well, you know, the insurance is capped. Yes, it's a volatility buffer. Yes, it's capped, but it's also floored. So there's a floor of zero, like this said. There's a 0% floor. Where did it say here? Right? The floor is zero. So yes, I have a cap, but what that means is, for example, if you see this chart here, see if this chart goes up, let's see if I can make it go up, right? If it goes down, right? So let's say it goes down, right? The S block, your money goes down, right? If with the 0% floor, with the insurance policy, and you see if I said a 15% return, the fucking insurance policy blows it out, right? If I do a negative 20% return, wow, the insurance policy still blows it out because you don't lose money, you just stay at a zero, right? And then when the money comes back, your money goes back. We'll look at it. So securities advisors, where was I? So security advisors sell the historical performance of the broad market, and they'll use an insurance policy's moving parts against it. The yield drag. Historically, the S&P 500 averages roughly 9 to 10% annually, even after a 1.5% wrap fee, not including things like capital gains taxes, because you got to include that. The net yield is 7.5 to 8.5%. Then when you add capital gains taxes, again, fucking Dalbar said the prudent investor gets about half. So notice this said the S&P averages that, and the S&P averages 7.8 to 8.5. You, Mr. Client, right? So for example, let me pick someone here. Cynical. Last time I checked, your name wasn't S&P 500. Your name was the cynical one. So you're not getting the returns of the S&P 500. Again, according to Dalbar, right? That's like going to the Pew Research. That's like somebody saying, yeah, I'm looking at, the behavior of people. Have you heard of Pew Research? I can bring up some independent study. Motherfucker, it's Pew Research. Either you're a retard or you're avoiding the conversation. I think it's the latter. I'd like to give a brother credit. Right? The carrier squeeze. The advisor will point out that life policies have cap spreads and par rates that insurance carriers can change at will. If an index hits 15%, but the policy cap is 8%, the client loses out on a massive bull market gain. Over a 20-year time horizon, they will argue that uncapped equity growth mathematically crushes the cap net of COI returns of an insurance policy. Then it'll do the straw man of margin calls. So, you pointed out the catastrophic risk of a margin call. The securities advisor will counter that this is a scare tactic that assumes gross mismanagement. Prudent advisors will not let clients borrow 80% of their equities. If a client has $1 million in a portfolio and takes a $200,000 S block, a 20% loan to value ratio, the market would have to crash to near apocalyptic levels to trigger a maintenance call. But let me ask you something. If you're supposed to be able to access all your fucking money, why would I put $1 million somewhere and then only be able to borrow $200,000? If I put it into a cash value life insurance policy, yes, I would have to put $225,000 in there, but I could borrow $200,000 of that $225,000. So let me ask you, ladies and gentlemen, to get access to $200,000, would you rather put up $225,000 or a fucking million? Oh, math. So let's look at the LTV margin call threshold. Again, it shows you this here, the market buffer. So what this means is any good advisor is not going to let you go over. And I told the gentleman 30% to be liberal. But once you start getting over that market buffer, if shit crashes, oh shit, they're going to make a margin call and they're going to start selling your positions. So the advisor will argue that by keeping the LTV under 30%, the client enjoys the liquidity of the S block without any realistic fear of forced liquidation, nullifying the primary advantage of the insurance contract's guaranteed collateral. Do you want a guarantee, Orlando? What's going on, brother? Yeah, I get a little extra spicy on the YouTube. Right? Ladies and gentlemen, do you want a guarantee or you want a possibly? Because this is a possibly. Right? So the margin call drop is if you go over 33%. Right? So the maintenance, if we go to 33%, we're safe. We go to 36%, oh, we're in trouble. Let's go to 50%. Since that's what he said, you can borrow 50 to 80%. You're fucking in danger, right? So I asked him, I said, well, what about Reg T rules? Reg T is Regulation T. What that means to you, the general public, is that when you're borrowing this money, it's a 2-to-1 ratio. So what that means is for every $2 that you borrow, you have to have $1 there to protect it, right? Versus a portfolio margin, like Orlando, our buddy, the hedged wolf, you for every $6.61 you borrow, I'm sorry, $6.67 you borrow, you only need $1. Would you rather borrow $2 to put up $1 collateral, or would you rather borrow $6.67 and put up $1 collateral? See, men lie, women lie, numbers don't, but it's a lesson in working together. Transparency and surrender mechanics. Finally, they will attack the rigidity of the insurance contract. With a brokerage account and an S block, the client retains total control. If they are unhappy with the advisor or the bank's interest rate, they can fire the advisor, transfer the assets in kind to another institution via NACAT, and negotiate the new S block rate tomorrow. There are no exit fees. If the client wants out of a life insurance policy in year 4, they take a massive haircut due to surrender charges. The advisor will frame the S blocks as transparent, flexible choice, and the insurance policy as a black box contract that locks the client's money up to pay high initial commissions. And my friend heard these commissions. So to win this debate with a high net worth client, you got to reframe the conversation. The securities advisor is comparing an aggressively managed stock portfolio to an insurance policy, and that's the wrong comparison. What do I always say? Well, you haven't been in those lives with me long enough, Orlando, but I generally say comparing insurance to an investment is like comparing a minivan to a Porsche. Yes, they both go, but they're two fucking different things. A Porsche is if you want to go fast. A minivan is if you want to carry a lot of people. Yes, they both have 4 wheels and an engine. That's absolute fact. But any registered investment advisor or a registered rep who's comparing insurance to investments is fucking commission hungry. They're fucking looking to rob you blind. Because a prudent investment advisor wouldn't compare insurance to investments. Right? What would that be like? Basketballs bounce. Footballs don't bounce as good as basketballs. Well, you know what? Soccer, in fact, they're both balls, though. In fact, soccer balls don't bounce as good as basketballs. They're both round. Well, yes, a soccer ball is meant to kick. A basketball is meant to be bounced and thrown into a hoop. They both go into a net, that's true, but they both serve different purposes. So, a properly structured IUL acting as a private reserve is not an equities replacement. It is a fixed income and cash equivalent replacement that provides superior leverage. Here is how you systematically dismantle their four strongest objections. Frictional cost, the front end load versus perpetual tax. The advisor will hammer the loss of day one capital due to premium loans and cost of insurance. And I think my boy's in the room. If he wants, he can go ahead and verify that literally as we were on the call, the motherfucker was doing this. And I was calmly asking, and I was asking him a lot of these questions. I just said, listen, don't take my word for it. I'm going to put it into AI to see if I'm bullshit. Because if I'm bullshit, AI will tell me. Right? So, you must pivot the client to look at the macroeconomic timeline, not the micro timeline of year one. The counter effects. Insurance costs are front-loaded. Orlando generally talks about front-loading when we talk, right? They're front-loaded, but they essentially flatline or diminish relative to the cash value over time in the max-funded structure. The advisor's 1.5% wrap fee is a perpetual tax on the client's growth. Ask the client, would you rather pay a one-time toll to get on a tax-free highway, or would you like to pay a percentage of your car's value every single mile you drive forever? Because that's what the AUM fee is, ladies and gentlemen. Over 20 to 30 years, an AUM fee charged on a continuously compounding balance will siphon hundreds of thousands of dollars more out of the client's pocket than the internal costs of an IUL. Furthermore, all the growth inside the IUL is tax-deferred and accessible tax-free, whereas the S block relies on underlying assets that will eventually trigger capital gains. But you can touch this money tax-free. You can do the same in life insurance. Remember, I said the power of zero. So uncapped equity versus policy caps and the power of zero. So remember, I showed you earlier, if it goes down, you stay flat, right? So the advisor will sell the uncapped upside of the S&P 500 and mock the caps and participation rates of an IUL. The motherfucker did that. Again, he was like, see, they train these people to do this. Yes, you were trained very well because they play on the emotions of the average person. They play with the retail investor. They ain't playing with the accredited investor like this. They ain't playing with the institutional investor like this. In fact, we about to do a new chat. Explain the retail, accredited, institutional, and QIB to, let's do this, qualified, institutional buyer to my YouTube audience from my perspective right now as I am streaming live and explaining it to them. Make sure it is easy to understand. Try not to use too much financial jargon, but explain it, explain with a simile to, with an analogy similar to, what should I use the analogy? Do we want sports or do we want cars? Somebody type in the chat. Do you want me to have it be analogized to sports or cars? Or you know what? Let's make it to food. To fast food restaurants. Let's say to restaurants. Let's see what it has to say. Live time, ladies and gentlemen, because that's how I like to do things. We just said cars. All right, a little late. Again, you got to know what you're talking about when you enter into it. Why is it not playing the sound? I wanted to read it out loud. I guess it's still typing. Okay, so I guess it wants me to explain it. It doesn't have the microphone. More options. It's not playing the sound for me. All right, so I'll read it to you, right? So it said, "What up, everyone? Welcome to the stream. I see the chat is already popping off. A bunch of you have been asking me to break down some crazy jargon that you hear in the financial world, specifically the difference between a retail accredited institutional and QIB, qualified institutional buyer. Finance bros love to overcomplicate this stuff to sound smart, but honestly, it's actually super simple. Let's completely ditch the Wall Street dictionary for a second, and let's look at the stock market like it's one massive restaurant scene." So the retail investor is the everyday diner. So first up, we got the retail investor. If you're watching these streams and you're buying stocks on an app on your phone, this is you. The vibe is that you're walking into your favorite local spot, looking at the standard menu and ordering a burger and fries for yourself. How it works: you're investing your own money for your own goals. You have access to the public markets, the regular menu that everyone can see. The catch: because you're an everyday diner, the government, think of them as the health inspector, put strict rules on the restaurant to make sure that your food is safe. The SEC requires companies to publish tons of public reports so that you know exactly what you're buying, right? So then you got the accredited investor, the VIP room member. So next we level up to the accredited investor. You're still eating with your own money, but now you have the black card. You get access to the VIP dining room in the back and the chef's secret menu. How it works: to get past the bouncer, you need to prove that you make a lot of money, over $200,000 a year, or have a high net worth over $1 million. The catch: on the secret menu, you can invest in private companies, startups, and inclusive funds. The catch there: the health inspector barely checks the food back there. It's higher risk and you might get food poisoning, aka lose all your money, but the government assumes you're rich enough to pay the hospital bill without going broke. Damn, I like the restaurant analogy. The institutional investor, the corporate event planner. Now we're moving away from individuals and talking about the heavy hitters, the institutional investor. The vibe: this ain't a person going out to eat. This is a massive corporate event planner buying out the entire restaurant to feed 5,000 people. How it works: these are giant organizations like pension funds, mutual funds, and insurance companies. They pool together regular people's money, the everyday diners, to make massive investments. So his argument was, well, if the insurance companies are investing like this, why the hell are you letting the insurance company do it? Because they get a coupon rate, meaning a discount rate, meaning they can buy out the restaurant for 5,000 people. You can buy yourself one fucking burger. They can buy burgers for 5,000 people. Would you like to put in a few dollars and go to an event where they have burgers for 5,000 people? Only 3,000 people show up, so there's 2,000 extra burgers. You could bring 3 burgers home to your family. The catch: because they're buying food by the truckload, they get special treatment. They negotiate better prices, lower fees, and get direct access to the restaurant owners. They move so much money that when they buy or sell, it can actually change the price of the stock for everyone else. Oh, you can't do that, Orlando. I'm not picking on you, but I'm just picking a random name out, right? Why can't you do that? Because you're not an institutional investor. Now let's look at the really big dogs. The qualified institutional buyer, the mega distributor. Finally, the boss level. The qualified institutional buyer. The vibe: this is the massive global food distribution empire. They don't just buy a meal, they buy the whole farm, the supply chain, and the trucking company. How it works: to be a QIB, an institution has to own or manage at least 100 million in investments. They are the absolute titans of the market. The catch: because they have so much money and so much experience, the government lets them trade entirely off the books in private unregistered deals. They trade massive blocks of shares with other mega distributors behind closed doors. The rules that protect the everyday diner simply do not apply to them. because they're considered the ultimate professionals. And then that's the quick menu, right? So that's that there. Let's go back to the S block versus insurance policy thing, right? So where was I here? So the power of zero, right? So the advisor will talk about the uncapped rates, right? So more important, and at least he did mention sequence of returns, which means he knows a little something, right? Because he was like, so the counter offense is that you're not competing for their risk capital, you're competing for their safe capital. The IUL is an opportunity fund. You've heard me say that many times, ladies and gentlemen, over the course of the last 6 years that I've been on YouTube. You've heard me say opportunity funds, right? More importantly, the advisor is ignoring sequence of returns risk. If the market drops 30%, the advisor's client needs a 43% gain just to get back to zero. And in IUL, zero is your hero. The 0% floor protects the principal, meaning that the client never has to dig out a hole. When the market rebounds, the IUL client compounds forward from their highest watermark, while the S block client is just trying to recover lost ground. The 20% LTV safe zone, a capital efficiency trap, right? You guys can see this, right? Let me make sure y'all can see this. Give me a second. I'm going to go grab some water. I'm a little dehydrated. I'll be right back. And like I said, hey, man. And like I said, I hope the brother is here because this is a valuable learning lesson. Right? Because again, remember Orlando this morning when I said, oh, I dealt with somebody with an S block. What did Hedge Wolf say? He was like, oh, they're talking about that bullshit. Buy term and invest the rest in a brokerage account with an S block. That's horrible. Orlando, tell me if I'm lying. If I'm lying, I'm flying. Right? So when the advisor says margin calls are a non-issue because they keep the S block at a 20% loan to value, they're walking into a massive trap regarding capital efficiency. Right? For a business owner or real estate investor, capital efficiency is everything. If the advisor requires $1 million of the client's capital to sit in a brokerage account to safely lend them $200,000, that is incredibly inefficient. 80% of their money is effectively trapped, acting as a buffer against market volatility. With the private reserve strategy, the collateral is guaranteed. A client can safely borrow 80 to 90% of their cash value without a single ounce of anxiety about a margin call. To get $200,000 of liquidity, they need only $225,000 in cash value. This frees up the rest of their net worth to be deployed into active investments, real estate, or business expansion. Right? You have the math. I hope you have the math. AI has the math right here. Right? So whatever math you're doing is inefficient. Right? Surrender charges versus tax-free completion. The advisor will attack the lockup period and surrender charges of the IUL, pitching their S blocks as fully liquid and transparent. Surrender charges only matter if the strategy is abandoned. High net worth individuals don't set up complex tax advantage vehicles with a 4-year exit plan. Again, we don't talk about risk tolerance, exit strategy, or time horizon. Right? No, I'm not going to do that, brother. There's no need when I got this information here. Right? I'll put it into AI live time. But again, I put this into AI and I'll go back to the beginning, my brother. Right? I said, if an agent recommends a brokerage account, how do they get paid? Percentage? Do they have a wrap fee and a 12B1 fee? Please explain why they're saying a brokerage account and S block is better for the client than using infinite banking strategy. I didn't even say that life insurance is better. I said, please explain why they're saying that an S block is better. It says when a securities license agent recommends a brokerage account paired with a securities backed line of credit over an insurance-based private reserve strategy, usually comes down to two things: protecting their compensation structure and a fundamental misunderstanding of guaranteed collateral. Like I said, brother, I won't work with you because you got passion. I don't want to be your enemy. I won't work with you so we could go take this whole fucking industry over as black men. So then I said counter against the life insurance strategy, right? And then let's see. It said if you successfully reframe the debate around capital efficiency and the zero floor, sharp fee only fiduciary or RIA will not back down. Instead, they will stop attacking the concept of a private reserve and start attacking the internal mechanics of the index universal life insurance contract itself. They will argue that an IUL is an opaque, structurally flawed product that shifts all the risk back onto the client. Here is how they will attempt to tear down the life insurance strategy. Zero floor is a mathematical risk. Now, here's the thing, right? Since the zero floor is a mathematical risk and it's speculative, right? And we look at, we're not talking about IBC, right? I got you. We'll ask it. But just so you know, I have a buddy who is a chairman, or excuse me, I have a buddy. Well, the interest on an IUL is calculated by participating or non-participating, but slow your roll, bro. I have a buddy who's a board member of the OCC, Options Clearing Corporation. Trust me, you're not talking to your average bear. Like I said, are you really using AI? Yes, I'm using AI because I know what the fuck I'm talking about. See, let me show you how AI works, right? If I do this, right? Hold on, we're just gonna go here. So I talked about QIBs to you earlier today. I talked about the retail investor to you earlier today. I talked about how they buy in Swartz earlier today. And I said, why would they, you said, well, why would they do no interest on the loan? What the, bro? Anyway, let me get back to what I'm doing. I'm not going to get distracted here. So, because I also took apart your 1928 to 1947. In fact, let's look at that, because what I told you was I was going to do numbers in live time, and I'm going to do numbers in live time. So I said the broker that we sat with gave us the worst 20-year point in terms of investments and taxes from 1928 to 1947, investing $10,000 a year, showing that the returns on the S block was better than a whole life policy from New York Life. Can you please give me a back test and give me the numbers investing $10,000 a year for that entire 20 years in the S block strategy with the brokerage account versus a whole life strategy, right? I didn't try to make one better or worse. It says the brokers are using a classic mathematical sleight of hand, sir. They're taking the absolute worst economic period. Did you not say, I used the worst period? You also wouldn't give me the age of the person. Suddenly it was a juvenile policy for somebody you were setting up an infinite banking for their child. Okay. So the brokers are using a classic mathematical sleight of hand. They're taking the absolute worst economic period in modern history, the Great Depression and World War II, and using it to illustrate the miracle of dollar cost averaging while completely ignoring how an S block actually functions in the real world. And you can't simultaneously laugh at me using AI and then ask me to use AI. Don't double talk, bro. Real pros see right through this kind of paper illusion. Building true wealth means being a work in progress every day and seeing success over the long term by protecting the foundation, not by running hypothetical back tests that ignore margin calls. Here is the exact numerical breakdown of what happened from 1928 to 1947 and how you dismantle their argument. If a client committed $10,000 a year for 20 years, $200,000 total principal, here's what the raw data looks like at the end of 1947. The strategy, total contributed 1928 to 1947, approximate 1947 ending balance, and how do I move this over? And the broker's claim. So S&P 500 with DCA with dividends, total contributed 200,000, approximate ending balance 360 to 400,000. The brokers can't claim that market grew your money by 100%. The New York Life, and I don't represent New York Life, whole life, cash value, 200,000. your approximate ending would be 240 to 260,000. And the reason I asked what is the age is because you also left out the death benefit, which is a form of collateral and something that if you drop dead anywhere in between investing, your family only gets the principal back. They don't get the death benefit. Again, you're not fucking with a rookie, cuz. Right? 240,000 to 260. The broker's claim, insurance dragged down your return. On paper, the broker points to the 400,000, which this is stuff you did, brother, and says the brokerage account won by a landslide. And on paper, it did. But here's the fatal flaw in their presentation. Their back test assumes the client never actually used the S block. And I didn't want to get disrespectful to you, brother, because I want to work with you. Because, again, you're a black man in America. This shit is hard for us. The only reason the fatal flaw, the 1929 to 1932 slaughter, right? Like I said, I'll show numbers in real time. I'm going to do just what you did. I'm going to use a 0-year-old. That's why I asked the age of the person, because then I could have in real time gave you numbers. So the only reason the S&P 500 backtest looks so good in 1947 is because the client systematically bought heavily discounted shares at rock bottom prices during the crash of 1929 to 1932 and held them for 15 years. But if the client was actually using this account as their private reserve and taking S-block loans against it, they would have never made it to 1947. They would have been liquidated. Look at the actual sequence of returns. And you said that, brother. So I'm not even trying to dish you because you did say we're going to ignore sequence of returns for the first 5 years of the back test. 1928 plus 43.8% return. 1929 minus 8.3, but you're still up. 1930 minus 25.1, but you're still up. 1931 minus 43.8. Oh shit, now you're down. 1932 minus 8.6. Now you're really down. If the client put $10,000 a year, by 1932 they contributed $50,000. Because of the catastrophic market crash, their account value would have been sitting at roughly $26,000. If they had borrowed even $15,000 against that portfolio using an S-block in 1929 or 1930, the bank's maintenance requirements would have triggered a margin call in 1931. These are things I said to you, but you said I'm trying to distract and we're not looking at the math. So I'm not going to bring you up here because, again, brother, sit down in the learning lounge. The client's portfolio goes to zero. The cheap shares are gone, and the magical $400,000 balance in 1947 never happens. The New York Life reality. Again, neither you or I represent New York Life. While the stock market was obliterating brokerage accounts and triggering margin calls across the country, here's what actually happened inside a New York Life whole life policy from 1928 to 1932. 1, zero market loss. The cash value contractually could not drop due to the stock market crash. Number 2, uninterrupted dividends, because you know New York Life has been paying dividends for 172 years, right? The longest paying dividend stock is a company called York Water Company. They've been paying dividends since 1816. I'm not even looking at the comments yet. Let me come in here. Bro, let it go. You lost. Okay. He says you're depending on AI. But now you're saying that AI just confirmed the math. You did not look at the math. Somebody, please, am I wrong here? Or is this motherfucker fucking retarded? Bro, I'm trying not to disrespect you, but you're talking like a fucking idiot. My nigga, what the fuck are you talking about? The numbers are proving me right. But let's go further, right? So absolute liquidity. Because again, these numbers, plus 43%, minus 83%, minus 25%, minus 43%, minus 86%. That shit didn't do anything to help you, my nigga. That shit hurt you. But again, I don't want to disrespect you because I want to fucking work with you. I want to team up like Voltron as black men. Right? New York Life and most major mutual carriers pay dividends to their policyholders every single year of the Great Depression. Absolute liquidity. In 1933, the federal government declared a bank holiday and shut down the banking system. People could not access cash from their banks or brokerages. Life insurance companies stayed open. Policyholders were able to take guaranteed policy loans to save their business, to feed their families, when the banks failed them. Now watch this. Since we're depending on AI, I said, give me a counter argument in favor of the S block, my nigga. I'm having a hard time fulfilling your request. Can I help you with something else instead? I'm glad you don't want to team up with me because you don't know what the fuck you're doing, cuz. I'm trying to be AI just went here. Let's ask, what did you say? Well, let me ask some of your questions. You just proved my point live. Rael is listening, my nigga. The death benefit doesn't include the cash value. In a properly structured IUL, it does. But again, you probably don't know that. Simple interest. Right. So let's do this. Let's do this. Let's do a new chat. So the broker wants me to compare interest rates on an S block versus the infinite banking, the IBC concept / private reserve concept. Please use 200K as the amount. He wants me to have you explain the interest rates on the loans. I'm a snake oil salesman. Let's see this here. Again, I'm willing to admit if I'm wrong, but right now I'm beating the shit out you, cuz, and I'm not trying to. I'm glad you don't want to work with me. My nigga, you're not looking at a nigga who don't know what the fuck he's doing, but I'm looking at a nigga who apparently don't. You must be fucking with Primerica, cuz. So let's see what it says here. When breaking down the $200,000 financing strategy for a broker, the conversation needs to move past the simple sticker price of the interest rate. The true cost of capital involves evaluating liquidity, market risk, and the underlying opportunity cost. Here is exactly how you can explain the mechanics of the interest rate versus a private reserve policy. An S block allows a client to borrow against their non-qualified investment portfolio without selling the underlying securities. The S block rates are typically variable. Hold on. Wait, my nigga, you said they was fixed. It literally said it's variable. It literally said it's variable. And an option B is not a rider, my nigga. Learn how this shit works. Obviously, you don't know. Maybe you were trained wrong at them companies you went to. I went through it too. Them white boys didn't want to teach me shit, cuz. I had to go get it out the mud and learn it myself. Remember, you said that those interest rates were fixed. So S block rates are typically variable and tied to a benchmark like the SOFR or the prime rate, plus a spread based on the total assets pledged. For a $200,000 line, rates currently hover between 6.5 and 8%. The math on 200K at a 7.5% variable rate, because remember you said they were simple, variable rate, the annual interest cost is $15,000. It's usually an interest-only payment required. The hidden risk. The biggest vulnerability here is the margin call. If the stock market takes a significant dive, and the collateral value drops below the maintenance requirement, the lender can force the liquidation of assets at market lows to cover the line. The private reserve IBC concept. Using a properly designed life insurance, like an IUL or dividend-paying whole life, as an opportunity fund, fundamentally changes the fundamental nature of the loan. You are taking a collateralized loan from the general account of the insurance carrier, using the cash value as the collateral. Wait a second here. The interest rate. The policy rates are generally fixed or feature a capped variable rate, often ranging from 5 to 7%. So, okay, the rates are around the same, 6.5 to 8.5. So let's just say they're both around 7%. So we can agree on that. But again, I literally typed what you asked. So don't tell me some bullshit about don't depend on AI, and then when I put in AI, exactly what you asked kicks your ass. So, using a properly designed, it fundamentally changes. The interest rate. Policy loan rates are generally fixed or feature a capped variable rate, often ranging from 5 to 7% depending on the carrier and whether it is a participating variable or non-direct recognition loan. The math on 200K. At a 6% loan rate, the gross annual interest is $12,000. The power of arbitrage. The critical differentiator here is the uninterrupted compound growth. The entire $200,000 cash value remains in the policy and continues to earn index credits or dividend if the policy credits at 6.5% while you borrow at 6%. The net interest rate is actually positive, plus 0.5%. The money is effectively doing two jobs at once. Furthermore, a market downturn does not trigger a margin call on a policy loan. The bottom line for the broker: the S-Block is a traditional banking product with a straightforward cost and significant market risk. The private reserve concept requires a paradigm shift. It transitions the focus from the cost of borrowing to leveraging the spread of arbitrage safely. To help you visualize this comparison in real time, here is an interactive model preloaded with the $200,000 scenario. You can adjust rates to demonstrate the exact net cost difference. So again, the S-Block, the private rate IBC. Annual interest, $15,000. Annual interest, $12,000. Credited growth, nil. Net impact, $15,000. Credited growth, $13,000. Net impact, plus $1,000. Right? I can change the numbers here. Let's see this. Generate an argument in favor of the S-Block. Let's see what it says. Generate an argument in favor of the S-Block. Defining the core need. Maybe it will. I don't know. We're doing this live time. I can help you destroy some of those insurance agents who don't know what they're doing. So to successfully argue in favor of the S-Block over the private reserve, you must shift the broker's focus away from just the interest rate and toward capital efficiency, underlying asset performance, and transparency. While a 7.5% S-Block rate might look more expensive on paper than a 6% life insurance loan, the broader context makes the S-Block a more powerful tool for a sophisticated investor. Here is the argument for why the S-Block is a superior choice for a $200,000 financing strategy, right? So the S-Block, a true cost of a loan cannot be separated from the growth of an asset acting as collateral. The S-Block advantage. The collateral for the $200,000 S-Block remains fully invested in the open market, e.g. equities, ETFs, mutual funds. Historically, a well-diversified portfolio. Oh, and while we're at it, hold on, because remember, if you disagree, then make a fool of me. I don't need to let you make a fool of yourself. I'm sitting here arguing for you now. I'm not going to bring you up because there's no need to. You are arguing. You already made a fool of yourself when you got emotional in the middle of our conversation. Yesterday when I asked, did you do discovery? And every time I interrupted or interjected, come on, man, you got to let me feel. You sound like a lot of these niggas, bitch-ass niggas crying over bitches. Right? So the IBC drag. Life insurance cash values are conservative by design. Once you account for the carrier's hedging costs, caps, and participation rates, the net historical growth of cash value is closer to 4 to 6%. The S-Block collateral will automatically outpace the insurance collateral over a 10-year horizon, easily absorbing the slightly higher interest rate, right? Building a $200,000, zero frictional drag and hidden cost, right? And again, this is in favor of your stuff. Now, watch this. The bottom line, when advocating for the S-Block, the core message is do not pay exorbitant insurance commissions and cap your market upside just to save 1.5% on the loan rate. The S-Block keeps the client's money in the market to avoid heavy insurance fees and provides transparent, immediate access. So based on these arguments, in your opinion, which would you recommend to an investor who wants capital efficiency, the ability, we'll just put it like that. Boom. Please provide an unbiased opinion. Damn, I can't spell today. OPINION. Bro, all right. I'm sure you would. Of course you would slap the dog shit out of me. That's why you're saying this shit on the fucking internet. Just like you're saying I wouldn't say this shit to you in your face. I promise you wouldn't say that shit to me in my face, which is why you have to type it on the internet, because now you feel big. Please, bro. Obviously, the reason that you're attacking and saying you'll slap the shit out of me is because I'm slapping the shit out of you, right? It says the S block wins, right? So the verdict, if the investor's primary objective is immediate capital efficiency and maximum asset velocity, the S block is the clear recommendation. It avoids the upfront toll booth of insurance expenses and keeps 100% of the capital, right? Now, what is the primary timeline or holding period of the investor anticipating? So let's say the primary timeline is not immediate, but an average time horizon of, let's say, 20 years. Right? Nah, don't attack him, y'all. It just is what it is. Right? Again, for the short term, it said the S block is the way to go. Let's see. A 20-year time horizon completely flips the script. When we move from a short-term liquidity play, which is how you're often trained to sell this shit, is, oh, bang, bang, quick, quick. When we know you don't look at risk tolerance, exit strategy, or time horizon, because the average time horizon is 20 years, which is why the average term insurance policy sold is 20 years. But I digress. Let's do this. Let's do so. I don't even need to do a lifetime illustration, right? Again, it said here in the short term, the S block won. I read it. I want to read the whole thing. When evaluating these two strategies through the lens of capital efficiency, an unbiased analysis points to the S block as the mathematically superior recommendation for the initial years of capitalization strategy. Capital efficiency is defined as maximizing the utility of every dollar deployed while minimizing dead equity, upfront fees, and frictional drag. Here is an objective breakdown of how each strategy stacks up against that specific method. Why the S block wins on capital efficiency, right? I did this in live time, but wait a second. Oh, you're depending on AI, so this is bullshit, right? Apparently. Of course, you would smack the dog shit out of me and get shot, but we ain't talking about that, right? So, again, chill with the bullshit, cuz. So, zero upfront drag, 100% allocation. With an S block, 100% of the investor's capital goes directly into the underlying investment portfolio on day one. There are no sales charges, premium loads, or policy fees. Every dollar is immediately exposed to market growth. Instant liquidity leverage. If an investor deposits $200,000 into a brokerage account, they can typically establish an S block for 50 to 70% of that value almost immediately, depending on the asset mix. The capital efficiency is realized instantly without a multi-year capitalization phase. No structural opportunity costs. The money used to secure the S block stays in the investor's chosen market vehicles, e.g. low-cost index funds or equities, which historically yield higher returns than the general accounts or capped index strategies of insurance companies. But before we go there, right, let's show the brother this. Because remember, Ra, you were there. I asked him, hey, are you familiar with Dalbar? You said, I can send you independent studies that our people are unaware of. Dalbar is the gold standard, right? Dalbar, quantitative analysis of investor behavior, right? What did it say here, right? Average equity fund investors historically earn around 9.8% annually, while the S&P earns closer to 13%. Asset allocation. Average asset allocation fund investors often see closer to a 4% return. Get the fuck out of here. Again, that's Dalbar. That's something that studies the history of investors. So a lot of the shit you're saying sounds nice short term, nigga. If you want to go get somebody a hit of coke, go ahead and get them a hit of coke. They'll be high for 15 minutes. But if you want that real dopamine, you hit the gym every fucking day. There's a difference in the strategy, right? And again, I'm reading here why your strategy wins in the short term, right? So when the private reserve concept falls short on capital efficiency, high frictional costs, to secure a $200,000 loan from a private, and remember, we were talking about $10,000 a year over the course of 20 years. So seeing that, you ain't got access to that $200,000 up front. This is assuming they put $200,000 up front, right? This ain't assuming that they're putting $10,000 a year in for 20 years. So I gave you the benefit of the doubt, bruh. So again, to secure $200,000 from a private reserve or IBC policy in the early years, the investor must actually deposit significantly more than $200,000 in premium. A large percentage of early premiums go to cost of insurance. I hate that they say agent commissions, because agent commissions are paid from a separate account. The only way the agent commissions are paid is if you charge a wrap fee, like that 1.5% that actually comes out of the client's money, and administrative overhead. Delayed velocity of capital. Because the structural fees inside of a permanent life insurance policy contract, it can take anywhere from 3 to 7 years for the cash value to break even with the total premiums paid. From a strict capital efficiency standpoint, that represents dead illiquid capital during the accumulation phase. If the investor's primary objective is immediate capital efficiency and maximum asset velocity, the S block is a clear recommendation. It avoids the upfront toll booth of insurance and expenses and keeps 100% of the capital working in the market while maintaining immediate access to a credit line. I don't see any other typing in here. Did the nigga leave? Right? Like I said, that's why I left, because I didn't want to disrespect you on your Zoom, because then you would have had to fly your ass out here to get put to sleep. And I wouldn't want to do that. I'd rather work with you, brother. But again, brothers get ego hurt. They get butt hurt. They can't call it down the middle. They become those bitch-ass niggas crying about Becky and Keisha. Right? So again, the S block is the clear recommendation. It avoids the upfront toll. I did this shit live time with you, bro. But now all of a sudden there's nothing wrong with AI, because it tells you that the S block is better short term. The private reserve IBZ concept should only be recommended if the investor prioritizes risk mitigation over capital efficiency, specifically if they want to eliminate the risk of market volatility and margin calls, or they're looking for long-term tax-free wealth transfer alongside their banking strategy. What is the primary timeline or holding period the investor is anticipating? The primary timeline is not immediate, but an average time horizon of, let's say, 20 years. A 20-year time horizon completely flips the script. When we move from short-term liquidity to a 2-decade strategy, the private reserve IBC concept becomes the vastly superior recommendation. In short, in the short term, the S block wins on a sheer capital efficiency. But over 20 years, remember, you showed us 20 years, bro. You didn't show us putting 200,000 in off the rip. So the math ain't mathing, bro. But over 20 years, The math of compounding interest and the reality of macroeconomic cycles heavily penalize the S block while exponentially rewarding the private reserve. Right? So, ladies and gentlemen, do I need to go any further? Anybody want me to continue? Oh, somebody time him out? Oh, damn. That's all good. Listen, the wrenches are active in this bitch. Right? I can't help it. He said, nah, Broke Genius sent him to the YouTube upper room. Right? Hopefully he's still watching. He just can't comment. But listen, folks is in here. They in here. Right? He says, sometimes you got to leave the comments anyway. It's all engagement. Anyways, it helps. Yeah, I mean, it often helps sometimes. But listen, my folks don't play. You got sent to the upper room via YouTube, bro. When you come back, we can definitely have the conversation. I'll gladly speak to you. Because like I said, I want to work with you, brother. But you ain't going to sit there and disrespect my integrity. You came off highfalutin. I was 7 years in the business. Oh, bro, I have 14 years in the business. I'm a member of the MDRT, $1 Million Roundtable, top 1% of financial professionals globally. I didn't include that in there. I belong to motherfuckers who work with the Saudi royal family. Like I said, I have people who are on the board of directors of the of the OCC, the Options Clearing Corporation. I've been approached to start hedge funds. I don't say that to toot my own horn, but don't come in here talking crazy when you don't know what the fuck you're talking about, cuz. It's okay. Be open to learning. Like I was open. This shit said there. I was like, oh shit, it says the S block is better. I read the whole shit for you. I put it in there to make an argument for the, what did I say here? I said, based on these arguments, no, wait. I said, generate an argument in favor of the S block. So in favor of your bullshit. But let's continue. Right? So here's why that 20-year timeline, because remember, we put 20 years in there, changes the verdict. The biggest drawback of the private reserve strategy is the frictional reserve of the first 3 to 7 years. Commissions, mortality charges, etc. However, over a 20-year period, those initial costs are mathematically erased. Once the policy breaks even, the cash value begins compounding uninterrupted. You are trading short-term drag for decades of tax-advantaged, highly efficient compounding. The power of uninterrupted arbitrage. This is where the private reserve pulls away. If you borrow $200,000 via a policy loan at 6%, but the underlying cash value is earning a 6.5% crediting rate, you are experiencing positive arbitrage. Over 5 years, 0.5% arbitrage is a nice perk. Over 20 years, that compounding spread generates massive wealth of money you're simultaneously using somewhere else. The policy becomes a self-sustaining financial engine. Eliminating the margin call kill shot. A 20-year time horizon guarantees that the investor will live through at least 2, possibly 3 major market corrections or recessions. The S block risk. If the market drops 30% in year 8, the lender will likely issue a margin call. The investor will be forced to liquidate their underlying assets at an absolute bottom of the market just to satisfy the credit line. This permanently destroys the portfolio's compounding potential. Oh, and by the way, just so we know, y'all, because again, the brother was talking about certain licenses. Hold on, I'm gonna turn on my camera for this. Let me turn on my camera for this. Right? Because motherfuckers talk about the licenses when all you have to do is pass a fucking multiple choice questionnaire, a multiple choice test for that. Hold on, how I turn off my virtual background? None. Right? So all you got to do is pass a multiple choice, cuz. Multiple choice test. I got the SIE here. I got the 63 here. I got another one for you. I got the, what is this? The 6. Hold on. I got another one for you. Right? The Series 65. You ain't got that. You might want to get that if you're trying to start your RIA. Right? I don't hold those licenses because then I couldn't come up here and talk the shit I talk. Like you can't. That's why I'm not letting you up here. I'm not going to let you risk your license and fuck yourself over like that. Because I actually give a fuck about another black man. But you don't seem to even give a fuck about yourself, cuz. Let me turn my camera back off and get back to this. So again, the IBC, safety. Policy loans are immune to market volatility. A life insurance carrier will never issue a margin call because the stock market crashed. The collateral is guaranteed. This provides total psychological and financial stability over a volatile 2-decade stretch. Interest rate volatility. S-block rates are variable. Oh, but I thought he said they were simple in the chat. Maybe he mistyped. It happens. Niggas fuck up. Niggas get shot every day, B. You'll be all right. While you might be paying 7.5% today, you are completely at the mercy of the Federal Reserve for the next 2 decades. Conversely, policy loans feature either locked-in fixed rates or heavily capped variable rates, giving the investor cost certainty over the life of the loan. The bottom line for a 20-year horizon. Over 20 years, the S-block is a fragile strategy. It leaves the investor exposed to variable interest rates and margin calls for 2 decades. The private reserve requires patience in years 1 through 5, but years 6 through 20, it transforms into an indestructible financial fortress that allows the investor to leverage their capital with absolute certainty, zero margin risk, and the mathematical advantage of long-term arbitrage. To truly understand how this paradigm shift happens, we have to look at the math over time. Here's a 20-year projection model. Notice how the initial drag of the private reserve is eventually overtaken by the safety of arbitrage, especially if you stress test the S-block with higher interest rates. We're just going to leave it at this. So again, in year 20, technically you're going to have more money because here, that initial $200,000 goes down because you don't have a shit ton to borrow against. Whereas the S-block, it does go up. Again, that's over the course of that 20 years. Was this visual helpful? Yes. Right? But again, as it compounds and keeps going, 198, 881, right? 220 is what they're saying. Right? So that's a good difference. But again, I just typed it in here. Literally what the brother asked me to type in was typed in. I think he was hitting the timeout. Oh, yeah. So again, bro, I had no dog in the fight, but you came in attacking me. And like I said, when I tried to agree with you and you was like, yeah, whatever, you was very disrespectful. I'll put it to you like this. You see how they canceled you out in the chat pretty quick. Don't let the smooth taste fool you, brother. That's why I came to you calm, cool, and collective. You should be more concerned with somebody who's calm, cool, and collective than somebody who's spewing random threats online. Right? I don't need to get emotional. I let the numbers do the talking. You let your lips do the talking. We witnessed it in live time when you, I, and the other gentleman, as well as Ra, were on the phone. We witnessed it in live time. Yeah, I know. Listen, he didn't have to. He started off hot, but he started off hot because just like AI said, they're going to attack the product or they're going to attack the person, your character. Because what happens is when we're in front of a client and they say, listen, I don't trust this guy. He's a snake oil salesman. That mentally does something to, unlike us who are wealth supremacists here on my channel, right? It does something to people psychologically. Again, it's just like niggas crying over Keisha. We seen them paying a Fresh and Fit be up there, right? The woman just starts to say a single word. No, I use a blah, blah, blah. Then she gets out of her frame and she looks bad because now she gets up, she starts mushing these bitch ass niggas and all that shit. I ain't got to do that. I ain't got to attack your character. I ain't got to threaten you with violence because I'm beating the fuck out of you with your argument. But anyway, folks, I'm going to get ready to shut this down. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor of Alonzo Hall, your social media insurance bro and registered financial consultant. And I just whapped and tapped on your head with another ADH wealth solution. Men lie, women lie, numbers don't. The numbers didn't lie. right? That's why I said, I asked AI, which one is better? AI said in the short term, the S block. If they trying to put $200,000 in today and get $200,000 out tomorrow, then the S block. But it said that's the short term. Over the long term, the IUL or the infinite banking concept is superior. So you see, I don't have to attack you because I know what the fuck I'm talking about. So when you know what the fuck you're talking about, I can hop in there and say, what about the LTV? Remember, I asked you, what about the loan to value, right? I said, yeah, what can they borrow on the insurance policy, right? Oh, up to 100%. No, it's actually up to 90%. But I understand. I even said I understand your apprehension because a lot of agents are selling based on what you said. Yeah, they'll come and tell you it's a 2% floor. I said, no, it's actually 0. But now I understand your animosity because you're encountering a lot of agents who are selling it like bullshit. Yeah, whatever. Oh, I hurt your fragile ego. I'm sorry that you feel that my dick is bigger than yours. We've never measured them. I will not measure mine against yours, but I will measure my knowledge against yours. I don't need to bring you up because I knew you were going to get out of frame and you would have gotten disrespectful. And yes, I would allow you to fly me to where you are to engage in fisticuffs if you'd like. I don't need to. You don't know what I know, who I know, bro. Just realize that. Again, I never came at you with disrespect. I tried to come at you professionally. I even said I want to work with you. I want to get you there. Now I know the reality is the brother probably wants to fuck with me and work with me, but again, for social media, it's always good to have a bad guy, right? I promise you, at the behind the scenes of this, me and this nigga will probably go have a beer and fucking laugh and joke and end up working together. Because he probably understands marketing and social media. There has to be a bad guy. There has to be a conflict, especially when it's amongst black folk. That's why I've got enough people in here. If I was talking about dick and pussy, it'd be 1,000 people in here. We're talking about finance. It gets a little boring. It might feel like paint drying, so it's not a shit ton of people in here. But what happens? The brother comes in, oh, disrespect. Niggas is going to watch. So I get what he's doing. It's a marketing genius. I hope that's the case, brother. I hope I didn't get you out of your frame, you know. But again, I agreed with a lot of your points. But the AI literally told us what it is here, right? And again, yes, AI can be wrong if you don't know what the fuck you're putting into it, right? That's like me. I don't know anything about medicine. So I would be like, what medicine is better for a headache? Don't know. Because I don't know what the end result is. But if I got a doctor in here and was like, hey, explain the difference between acetaminophen and ibuprofen and XYZ-ofen, they already know the answer. Explain to me why XYZ-ofen is this, acetaminophen is this, ibuprofen is that. Advil versus Tylenol. And XYZ-ofen is some random shit. So anyway, folks, it's your boy, the Insurance Junkie, your fiduciary fella, the all-star advisor, Alonzo Hall, your social media insurance bro and registered financial consultant. And I just whacked and tapped on your head with another ADH wealth solution. Make sure to hit, and even my comment here says you don't need life insurance, because that's what I've been talking about, or my profile, my picture. You don't need life insurance, ladies and gentlemen. You need what life insurance can do for you, like we just showed here. Again, life insurance ain't a short-term strategy. So to his point, because what a lot of insurance agents are running around and doing is they're selling y'all some bullshit. He said, financial literacy is boring. Chitlin circuit content get more eyeballs, and most of them motherfuckers are broke. Big facts. Big facts. Right? So, again, like I said, I assume the brother was just doing that because, again, he knows, damn, it's not a shit ton of niggas in here. Let me do some wild shit, say some wild shit, banter back and forth, argue back and forth. If me and him was up here arguing back and forth, we had 300 niggas in here. Oh, they fighting, right? I got about 70 y'all in here right now. Why? Because this is boring, but boring is where the money's at. But to his point, he said some valid shit. Yo, a lot of insurance agents are on some bullshit because a lot of insurance agents are like, put $100 a month into an IUL and you'll be a bazillionaire. So I'm sure he tears apart a lot of insurance agents because they don't know what the fuck they're doing. But again, you're talking to somebody who, when you started off, I got 7 years in the game, blah, 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 blah. I sat there stoic, like the picture here. I want to work with you, bro. Let's work together. Wipe ass. Work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.